Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So in today's session, we are going to discuss the recommendations that is provided by the internal working group of the Reserve Bank of India in regards to the liquidity management framework. That is a very important framework under the Reserve Bank of India. So the RBI has released the report of the internal working group in regards to the liquidity management framework. So what are the recommendations that have been provided by the internal working group, and what is this internal working group? All of this we are going to discuss in today's session. What is this liquidity management facility? You are going to have the idea regarding these important terms and these important framework. Okay, so let's get started with today's session. But before that, give me a thumbs up if I'm clearly audible and visible. And this recommendation, it is very important from the objective part of the examination for the RBI grade B, for the RBI grade A examination. And today we will discuss that what are the major recommendations that have been given by the internal working group for the liquidity management framework of the Reserve Bank of India. Okay, so this is also quite in news recently, so this becomes very important. So let's get started, but give me a thumbs up if everything is fine, if I'm clearly audible and visible. Okay, thank you for that. Now before starting, do subscribe to the YouTube channel of EduTap if you have not done till now, so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's get started with the report of the internal working group to review the liquidity management framework, and the recommendations have been provided by the internal working group to update or to review the liquidity management framework. So the Reserve Bank had constituted an internal working group to review the existing liquidity management framework that has been in operation since February 2020. So the liquidity management framework that is operating right now, this has been in operation since February 2020, and to review this liquidity management framework, there was the internal working group that was established, and the chairperson of the internal working group was Dr. Poonam Gupta, the Deputy Governor, as well as Shri G. Shearshi was the member secretary. So this is the idea, this is the composition of the internal working group. Here you can see the executive directors, the deputy director and the chief general manager. They were the members of the internal working group. That's why it is called internal working group, because this is the working group from inside the Reserve Bank of India only. Okay, so RBI had constituted this internal working group to review the liquidity management framework. Now the liquidity management, first of all, I hope you know about the liquidity adjustment facility. Under the liquidity adjustment facility, the liquidity can be adjusted. Okay, if there is less liquidity in the economy, if there is less money supply in the economy, that is, there is deficit in the money supply, so the RBI increases the money supply so that there is enough money supply in the economy. Let's say there is excess of money supply, there is too much money supply in the economy, there is too much liquidity in the economy. So RBI reduces the money supply so that there is only enough of the liquidity in the economy that is required by the economy. Okay, so the liquidity is adjusted. If there is too much liquidity, that is reduced. If there is too less liquidity, that is increased. Okay, so liquidity is adjusted. Now under the liquidity adjustment facility corridor, what are the variables here? So liquidity adjustment facility has the tools. The liquidity adjustment facility tools are the repo rate, the MSF rate, the SDF rate, as well as the reverse repo rate. So these are the tools under the liquidity adjustment facility. But the corridor, the liquidity adjustment facility corridor consists of repo rate, SDF rate and the MSF rate. Okay, so the liquidity adjustment facility tools are repo rate, reverse repo rate, MSF rate, SDF rate. But in the corridor, in the LAF corridor, there is the SDF rate, the repo rate and the MSF rate. Okay, why is there reverse repo rate? Because the variable reverse repo rate, the variable repo rate and reverse repo rate auctions, they are very regular, and the RBI keeps on conducting the auctions for the repo rate and reverse repo rate. Okay, that's why in the liquidity adjustment facility, whenever the liquidity has to be adjusted, the RBI also uses the variable repo rate and reverse repo rate auctions. That's why in the liquidity adjustment facility tools, these are the tools: repo rate, MSF rate, SDF rate, reverse repo rate. So the fixed repo rate, that is fixed under the monetary policy. The SDF rate is also fixed. The MSF rate is also fixed under the monetary policy that is decided by the Monetary Policy Committee. But there is also the variable repo rate and variable reverse repo rate auctions that happen through which also the liquidity is managed, through which also the liquidity is adjusted. Okay, so here the reverse repo rate, the fixed reverse repo rate, that we are not talking about. We are not talking about the fixed reverse repo rate that was replaced by the SDF rate. The fixed reverse repo rate was replaced by the SDF rate, but there is something known as variable reverse repo rate that is still quite in use by the Reserve Bank of India. Any confusion here? Everything clear? So liquidity adjustment facility tools consist of repo rate, the fixed repo rate we can say, the MSF rate, SDF rate. SDF rate replaced the fixed reverse repo rate, but variable reverse repo rate is still used by the RBI. Variable repo rate is also still used by the Reserve Bank of India to manage the liquidity. We will discuss more about these variable rates, but this is the liquidity adjustment facility tools. Okay. Now, the liquidity adjustment facility tools consist of the repo rate, the SDF rate, the MSF rate, as well as the variable reverse repo rate we can say. Now these are the tools under the liquidity adjustment facility that helps in managing or that helps in adjusting the liquidity. Now liquidity adjustment tools plus there are certain other tools also that is with the Reserve Bank of India, like the open market operations. Open market operations through which the RBI can purchase. I hope you know about the open market operations. Open market operations in which RBI purchases the government security from the banks, from the commercial banks, and for the purchase the RBI is providing the money to the banks. So if there is less money supply with the banks, the RBI increases the money with the banks through the purchase of the government securities. Okay, let's say there is too much money supply with the banks. There is too much money supply with the banks. So in this case, the RBI under the open market operations sell the government securities to the banks so that the banks have to provide the excess money to the RBI for the purchase of the government securities. So RBI reduces the excess liquidity with the banks by selling the government securities to the banks. So this comes under open market operation. So to manage the liquidity, the RBI also has the tool that is open market operation. Okay, as well as there is also foreign exchange swaps that also happen. Let's say the RBI is giving the dollars to the banks and RBI is taking away the rupees from the banks. So these kind of swaps also happen. So foreign exchange swaps can also be used by the RBI to manage the liquidity, to manage the rupee in the economy. Okay. So there are additional tools. These are also known as fine-tuning operations or fine-tuning tools that can be used in case the RBI want immediate action in the liquidity. Okay. So this is the idea that in the liquidity management facility, under the liquidity management facility, there is the liquidity adjustment facility tools, as well as there are other tools also. And the liquidity management facility, this is the whole idea, this is the whole framework under which the RBI uses the tools to manage the liquidity in the economy. So LAF tool, liquidity adjustment facility tools, it provides the tools for RBI to manage the liquidity. So RBI using these tools as well as the additional fine-tuning operations, the RBI has the complete framework that how the RBI can use these tools to affect the liquidity in the economy. Any confusion here? Is this clear? So liquidity management facility, this is the whole framework. This is the whole framework under which RBI uses the liquidity adjustment facility tools as well as additional tools to affect the liquidity in the economy. So now you understand the difference between liquidity management facility and liquidity adjustment facility. Liquidity adjustment facility, this is under the liquidity management facility, that is the complete framework, that how the RBI will use the different tools, for what tenure the RBI can use the different tools. So this is the whole framework. Okay. I will discuss the auctions with you. I have brought that, but this overall idea, is it clear? We will discuss more about the auctions and the variable reverse repo rate and the repo rate. We will discuss about it. But is this clear, right? Now, moving forward. So basically, the liquidity management framework, this is the whole framework. This is the whole framework, the liquidity management facility or the liquidity management framework. This is the whole framework that how the tools can be used, at what time the tools can be used, in what scenario the tools should be used. Okay. And liquidity adjustment facility, this provides the adjustment tools. Okay. This is the idea. So liquidity management is the operating procedure of monetary policy, primarily aiming to align the targeted money market rate to the policy rate. Money market rate. Money market is the short-term market. It is the short-term market where the banks are borrowing as well as they are lending to the other banks. Okay, so money market is the market in which the short term borrowing and lending happens, and usually the banks are very much involved in this money market where the interbank lending and interbank borrowing happens. Whenever the banks have liquidity crunch in the money market, they try to borrow the funds. If the bank has excess funds in the money market, the banks lend the funds out. Okay, and money market is usually, like in the money market there is call money. Call money is the overnight lending and borrowing that is happening. Then there is the notice money. In the notice money, the borrowing and lending is for 2 days to 14 days. Then there is also term money, that is for a longer period of time from 15 days onwards. Okay, so in the money market, it is usually the short term market where the short term borrowing and lending is happening, and the banks are very much involved in borrowing and lending the funds, because on the overnight basis also they require the funds to maintain the cash reserve ratios, to maintain the reserve ratios and such. The banks require the funds and such. So call money is the overnight lending and borrowing that happens. Okay, so I hope you know about the money market structure. In the money market, there is this is the short term borrowing and lending market where there is call money, that is the overnight borrowing and lending that is happening. Then there is the notice money, that is the lending and borrowing is for 2 days to 14 days. And then there is the term money. Okay, so this is the money market structure. Now, in the short term, the RBI wants that in the short term, the monetary policy should align, or primarily aiming to align the targeted money market rates to the policy rate. So if the policy rate is changing, if the repo rate is increasing or the repo rate is decreasing, so that should affect the money market rates, because money market is the short term market or the short term rates, so that should be affected. Okay, to achieve the first step in the monetary policy transmission, so that if the RBI is decreasing the repo rate, the interest rate can decrease in the economy, especially in the money market, in the short term market. If the RBI is increasing the repo rate, the interest rate can increase in the money market, in the short term market, so that the interest rates are aligning with the repo rate. So for the monetary policy transmission, the RBI wants the money market rates to be aligned. Okay, so the RBI wants that the monetary policy should be aligned with the money market rates, or the money market rates should be aligned with the monetary policy rate or the policy rate. I hope this is clear. Now, an effective LMF facilities. So liquidity management framework facilities. So an effective LMF facilitates the maintenance of appropriate liquidity in the banking system. As I have told you that liquidity management framework, this is the whole framework that is facilitating the maintenance of appropriate liquidity in the banking system using the liquidity adjustment facility tools as well as the fine tuning operations, and the other operations are used so that the liquidity is maintained at the appropriate level in the banking system and in the economy, and this fosters the money market development. So liquidity management framework facilitates the maintenance of appropriate liquidity in the banking system, and it fosters the money market development also. The Reserve Bank's LMF has undergone a process. So liquidity management framework has undergone a process of continuous refinement, and the last update that happened in the liquidity management framework, it was in 2020, since when the recent liquidity management framework is in operation. Okay, so this is the idea. So Reserve Bank's current LMF implemented in February 2020 has been operative for more than 5 years now, with a brief pause during the COVID-19 pandemic. So you can understand that the liquidity management framework that we are following right now, it has seen COVID-19, it has seen Russia-Ukraine war, and it has been viable even in the conditions where there was huge outflow of money or a huge outflow of foreign exchange that was happening. So the liquidity management framework that we are following right now, that RBI is following right now, it has been strong even in the most difficult times, and that's why the RBI is saying that we have a good liquidity management framework, but we want it to be reviewed so that we can take further steps for it. Okay, so Reserve Bank had constituted this internal working group for review of the existing liquidity management framework. Now the LAF, under the current liquidity management framework, I have told you that liquidity adjustment facility, this is under the whole liquidity management framework. This is based on corridor system. So liquidity adjustment facility, the liquidity adjustment facility, it has a corridor that you all know, that is repo rate. SDF rate is less than the repo rate by 0.25%, and the MSF rate is greater than the repo rate by 0.25%. Okay, so the liquidity adjustment facility under the current LMF is based on corridor system with the repo rate in the middle of the corridor, the MSF at the ceiling of the corridor, and the standing deposit facility at the base or at the floor of the corridor. Okay, now SDF, which was operationalized with effect from April 8, 2022, it replaced the erstwhile fixed rate reverse repo as the floor of the LAF corridor. So before, the LAF corridor used to have the fixed reverse repo rate, the repo rate, and the MSF rate. These are the fixed rates that are fixed as per the monetary policy. Now the fixed reverse repo rate, it was replaced with the SDF rate, and now we follow the SDF rate as the floor of the liquidity adjustment facility. Okay, this is the idea. Next, so Reserve Bank constituted an internal working group to evaluate the current LMF, current liquidity management framework, and suggest appropriate changes for effective transmission of monetary policy. So now we will discuss the recommendations that have been given by the internal working group one by one. So there are approximately 8 to 9 recommendations that have been given by the internal working group. So we will understand that. But I hope now you have understood the basic idea that why we are studying this report and why it is so important, because the whole monetary policy, RBI has said that we are trying to increase the repo rate. RBI is saying that we are increasing the repo rate. How this repo rate will affect the interest rate? The interest rate should increase in the economy. If RBI is trying to increase the repo rate, the interest rate should increase in the economy. How the transmission will happen? How if with the increase in the repo rate, how the interest rate will start increasing in the economy? So it depends upon the monetary policy transmission that happens through the liquidity management framework. Okay, where the money market rates are targeted and the money market rates should change with the repo rate. Okay, this is the idea. I hope it is all clear. Moving forward, it will become more clear. So under the existing liquidity management framework, the overnight WACR, that is the weighted average call rate, call money, I have told you, call money is the overnight market where the borrowing and lending happens between the banks. Banks are able to borrow for the overnight and banks are able to lend for overnight, because let's say, I hope you remember or I hope you know that the cash reserve ratios, if the cash reserve ratio is 4% of the NDTL, that is 4% of net demand and time liabilities, the deposits that the banks have, the demand deposits, the time deposits that the bank has, on the net basis, the demand and time deposits that the bank has, out of which 4%, let's say 4% CRR the banks have to maintain. So the RBI has said that on the daily basis you can maintain 90% of the CRR on the daily basis. On the daily basis, the banks have to maintain the 90% of the CRR, and fortnightly this has to be reported, and on the fortnightly basis you have to maintain 100% of CRR. So basically the cash reserve ratio, daily maintenance of the cash reserve ratio should happen. That means daily the reserves have to be maintained by the bank, okay, with the RBI. So daily the cash reserve ratio has to be maintained, that is 90% of the CRR has to be maintained actually on the daily basis. So on the daily basis 100% of CRR is not required, at least you should be maintaining 90% of the CRR that is notified by the Reserve Bank of India. And on the fortnightly basis, you will have to have the 100% of CRR on average. So on daily basis, even if you have like 95% or 92% or 98% of the CRR, that is fine. But on the fortnightly basis, on average, the average will be taken. You should have the 100% of the CRR that is notified by the Reserve Bank of India. Now, this is the idea. So let's say some bank is not able to meet this daily target of 90% of CRR. So the bank has taken the overnight borrowing so that the bank can maintain the daily CRR limit. Otherwise there will be penalty imposed by the Reserve Bank of India. So the bank has done the overnight borrowing to maintain this CRR, that is on the daily basis it has to be maintained. So that's why the overnight market is also very important, because the banks require the overnight funds also, the immediate funds also, that the bank can return on the next day. Okay, so call money, this is for the short term, for the overnight. This is the overnight borrowing and lending that happens. So weighted average call rate, this is the average call rate, or this is the weighted average call rate, that is the overnight rate in the money market. So under the existing LMF, the overnight WACR is the operating target of the monetary policy. That means that if the RBI is increasing the repo rate, the RBI targets that the WACR, that is the weighted average call rate, should increase. If the RBI is decreasing the repo rate, RBI wants WACR to decrease, the call rate to decrease. Okay, this is the idea. The objective of liquidity management operations is to align the target rate to the policy repo rate. This rate has to be, the overnight WACR has to be aligned with the policy repo rate. If the repo rate is increasing, the target rate, that is the WACR, has to increase. If the repo rate is decreasing, the overnight WACR has to decrease. Okay, so this is the idea. So now I hope you will remember that the repo rate, if it is changing, the target is to change in the same line, to change the overnight WACR, because this overnight weighted average call rate, this is very much affecting the banks. This is the idea. Now, pursuant to the recommendation of the working group on operating procedure of the monetary policy, the WACR, that is the overnight weighted average call rate, was recommended to be the operating target of monetary policy of the Reserve Bank of India. So if the repo rate is changed, the aim is to align the overnight WACR with the repo rate. This is the idea. Okay, now what is the recommendation? This is the previous idea. This is the previous idea, that what is happening till now. So now the recommendation is provided by the internal working group, that the group recommends that the overnight weighted average call rate may continue as the operating target of the monetary policy. That means still with the changes in the repo rate, the target should be to change the overnight WACR and to affect the overnight WACR, because if the repo rate is changing and in the same line the overnight WACR is changing, so the interest rate will change in the same direction. This is the idea. The Reserve Bank may, however, continue to keep track of rates in other overnight money market segments also. So there are other overnight money market segments like the repo operation, the repo operation. This also happens between the bank. The banks are also lending or borrowing from each other against the collateral. So that is repo operation. So the banks also borrow as well as they also lend. In the repo operation, that is happening interbank. Against the collateral they are borrowing, they are lending to each other also. Okay, so in the call money market, this is usually the call money. Here the borrowing and the lending is happening on the overnight basis, where usually the collateral is not taken. Then there is also the repo market, where the interbank borrowing and the lending is happening, where the collateral is involved, for the overnight transactions also, for the overnight borrowing and lending also. So call money is also the interbank borrowing and lending is happening but without any collateral. But in the case of repo operations or the repo market, in this the interbank borrowing and lending is happening where the collateral is involved. So it is said that the group recommends that the overnight weighted average call rate may continue as the operating target of the monetary policy, but it has been recommended by the internal working group that the Reserve Bank may, however, continue to keep track of rates in other overnight money market segments also, to ensure orderly evolution of the money market rates and smoothen transaction. That means if the repo rate is increasing, it is seen that the overnight WACR also increases. So the internal working group is saying that we have to look after the other overnight markets also, so their rates also increase or their rates also change as per the repo rate. Okay, the main target should be the overnight weighted average call rate, but we have to look after the other market segments also, the other money market segments also. This is the idea. Any confusion in the first recommendation? Now coming to the second recommendation, that is group recommends continuation of the existing corridor system with policy repo rate in the middle, SDF as the floor rate and the MSF as the ceiling rate. Okay, the corridor system should continue to reduce uncertainty in the market about the tenure, quantum and timing of the repo or reverse repo operations. So see, reverse and the repo operation, so that is the auctions are happening. The auctions are happening. The repo auctions as well as the reverse repo auctions are happening. Reverse repo operations are happening. So these auctions that happen, these variable repo rate and at the variable reverse repo rate, the auctions are happening. So there should be the tenure that should be notified beforehand, the quantum that for how many crores the money will be given. So basically, if the repo rate or the reverse repo rate auctions are happening. Now, how the auctions happen, that we will discuss in the next slide. But basically, if the variable repo rate and variable reverse repo rate auctions are happening, so the tenure has to be notified beforehand that we will be doing the overnight auctions or we will be doing the auctions for the variable repo rate or variable reverse repo rate for the 7-day or 14-day. So the tenure has to be identified or it has to be notified beforehand, the quantum also, that we are doing the auctions for 50,000 crores or for 25,000 crores and such, and what will be the timing for the auction of the repo or reverse repo operations. The group felt that it is desirable for the Reserve Bank to provide sufficient advance notice to market participants at least 1 day prior to the auction. So at least 1 day prior to the auction, it has to be notified to the market participants, to the banks and such, that okay, we are going to do such a auction for such a timeline, okay, while conducting any such liquidity operation. So if the Reserve Bank of India is conducting the variable repo rate auction or variable reverse repo rate auction, so it has to, the tenure, the timing, the quantum has to be notified to the banks and to the market participants 1 day prior. This is the recommendation provided by the internal working group. The next is the group observed that there may be situations in which the evolving liquidity conditions may warrant. So it is said that there might be some situation that immediately there is requirement to reduce the liquidity or to increase the liquidity, and in this case maybe 1 day prior notice cannot be provided, so that should be allowed to the Reserve Bank of India. So group observed that there may be situation in which the evolving liquidity condition has to be managed immediately. So in this condition, on the same day the announcement should happen and on the same day the auction should also happen. So this is not compulsory. 1 day criteria is not compulsory. 1 day criteria should be followed by RBI, that 1 day prior to the auction the RBI should notify that tomorrow we are going to do the auction. So 1 day prior to the auction, the RBI should notify to the market participants. But in case RBI is not able to notify, that is also fine. Then also the RBI should continue the operations. Okay. The Reserve Bank may conduct repo, reverse repo operation announced on the same day. So basically, in the general condition, the RBI can announce the auction today and tomorrow the auction can happen. Okay. Now, in certain conditions, when the liquidity situation is immediate and immediately the action has to be taken, today only the action has to be taken. So today the announcement will happen and today only the auction will happen. So the RBI in the general situation should follow this criteria, but in the immediate and the uncertain situation, the RBI can follow this criteria also, that on the same day the auction and the announcement is happening. This is the idea. Next, now coming to the auctions, that the variable reverse repo rate or the repo rate auctions, what are these? Okay, so first of all, the group recommends continuation of variable rate auctions mechanism for conducting repo and reverse repo operations under the liquidity adjustment facility. As I have told you that under the liquidity adjustment facility, there is the repo rate. This is the fixed repo rate that is fixed by the monetary policy. Then this is the SDF rate and the MSF rate that is fixed by the monetary policy committee. Then there are, under the LAF, there is also the reverse repo rate. This is the variable reverse repo rate, and the RBI can also use the variable repo rate to manage the liquidity in the economy. Now, what is this variable reverse repo rate and variable repo rate? First of all, the group has recommended that we have to continue with the variable rate auctions, with the variable reverse repo rate auction and the variable repo rate auctions. Okay, so here the reverse repo in this recommendation is not referring to fixed rate reverse repo. It is not referring to fixed reverse repo rate, that is now outside the corridor, but to the variable auctions, variable reverse repo rate auctions. So variable reverse repo rate auctions are still part of the LAF operations. They are RBI's main tool to absorb the surplus liquidity, and these kind of auctions happen in the economy. Okay, so try to understand that. First we will understand about the variable repo rate auction. So here this is how it happens. So notified amount. So RBI has said that the variable repo rate auction is happening. The variable repo rate auction is happening. Now what is repo rate? What is repo rate? Repo rate is the rate at which the banks can borrow the funds, or the banks can take the loan from the Reserve Bank of India, and the bank has to provide the collateral to the Reserve Bank of India in the form of government security. So this is the repo rate auction, or this is the repo rate operation. Okay. Now variable repo rate means that the rate is not decided. So banks, it is told to the banks that the banks are able to borrow from the Reserve Bank of India immediately. On the immediate basis, the banks can borrow from the Reserve Bank of India, and the banks can provide the collateral to the RBI. But this is the variable repo rate. That is, this rate is not decided. This rate will be decided by the bidding, or by the auction. Okay. So operational guidelines are that basically the auction will be conducted on the CBS eKuber platform. eKuber platform, core banking system of the Reserve Bank of India, through which the interaction of the RBI happens with the banks. Okay. So this is the core banking system of the RBI, eKuber platform. So auction will be conducted on the CBS platform. The minimum bid amount for the auction would be rupees 1 crore and multiples thereof. That means if the bank want 10 crore rupees or 11 crore rupees, that is the amount the bank can borrow. So bank can borrow, the minimum bid amount can be 1 crore and multiples thereof. The allotment would be in multiples of rupees 1 crore only. It's not like 1 crore 10,000 rupees, 1 crore 10 lakh rupees. No, only in the crores the allotment will happen. Banks would be required to place their bids in percentage terms up to 2 decimal places. 2 decimal places means, let's say that I want to borrow at 5.67%, or I want to borrow at 5.51%, or I want to borrow at 5.52%. Okay. So the bidding has to happen with the percentage, because at what percentage you want to borrow. So banks have been given the freedom that they can like bid that, okay, I want to borrow 10 crore rupees, or I want to borrow 100 crore rupees at 5.51%, or at 5.67%, or at 5.71%. So the banks will have to bid at what percentage they want to borrow. Okay. So the banks would be required to place their bids with at least 2 decimal points. Banks can place multiple bids also. Successful bids will get accepted at their respective bid rates. So if the average bid rate is 5.51%, but a bank has said I can borrow at 5.67% during the bidding, so at that percentage only the bank will have to borrow. This is the idea. So successful bids will get accepted at their respective bid rates only. Bids at or above, below the repo rate will be rejected. That means if you are borrowing under the variable repo rate, you cannot borrow at the fixed repo rate. You cannot borrow at the fixed repo rate or below the fixed repo rate. At this rate, you cannot borrow. If you want to borrow at this rate, then directly borrow under the fixed repo rate. Under this corridor of the repo rate, if you want to borrow at 5.50%, that is the current repo rate, so you can borrow under the fixed repo rate. But remember that under the fixed repo rate, there are limits on the per bank basis. And if you have utilized the limit, you have already borrowed under the fixed repo rate, then you want to borrow more, then you can borrow under the variable repo rate by bidding a slightly higher percentage, okay, and paying a slightly higher percent. So this is the idea that the variable repo rate, here the bidding happens where the rate should be above the repo rate, above the fixed repo rate. So bidding can happen above the repo rate. The bids at or below the repo rate will be rejected. Bids at or below the fixed repo rate will be rejected basically. Once the bidding time is over, all the bids would be arranged in the descending order from the highest to the lowest, and then there will be the cutoff rate that will be decided. So here you can see that the results have been released for the overnight, variable repo rate. So overnight means for one day only the borrowing is happening. The tenure was 1 day. Notified amount was 50,000, but actually total amount of bid receipts were 31,025. So the cutoff rate was 5.51%. This was the cutoff rate. So any bank that have bid at 5.55%, they will have to pay this much only. If a bank has bid at 5.65%, they will have to pay this much only. The cutoff rate is 5.51%. Okay. So this is the idea. Any confusion in the variable repo rate auctions now? Any confusion? Got it? Any confusion? So variable repo rate is always higher than the repo rate. Bids at or below the repo rate will be rejected. So the repo rate is 5.5% currently. That's why the variable repo rate could be 5.51% and such. Okay, clear. Nice. Now variable reverse repo rate. Under the variable reverse repo rate, what happens? So the same procedure is followed for the variable reverse repo rate also. Variable reverse repo rate, in this banks can deposit their funds. The banks can deposit their funds with the Reserve Bank of India, and the RBI has to provide the collateral to the banks in the form of government security. Now RBI wants to absorb the liquidity. RBI wants to absorb the liquidity. That means the banks have too much money supply. The banks have too much money supply. RBI wants to take away this money. So if RBI wants to absorb the liquidity from the banks, the RBI can use the variable reverse repo rate. Okay. So here the banks will deposit their funds with the Reserve Bank of India. So banks are transferring their funds to the RBI. So the excess liquidity is reduced with the banks and the liquidity is being absorbed by the Reserve Bank of India. So RBI continues with the variable reverse repo rate auctions that happens on the whenever the RBI wants. So RBI can conduct these kind of auctions whenever the RBI wants, because these are the variable reverse repo rate auctions and such. Okay, so auctions the RBI can do whenever the RBI want, and this is done to reduce the liquidity immediately. Okay, in this case what happens that the banks can the bank can bid that, okay, I want to deposit this much, I want to deposit 100 crores, I want to deposit 200 crores, I want to deposit 1000 crore rupees with the Reserve Bank of India, and in the auction the bidding happens for the percentage that I want to deposit at 4.5%, I want to deposit at 5.15%, I want to deposit at 5.25%. Then the bids are arranged in the ascending order from the small to the highest, that which bank is ready to take the less percentage. Let's say 4.5% the bank is asking, some other bank is asking 4.75%, some other bank is asking 4.85%, some other bank is asking for 4.91%, some other bank is asking for 5.15%, and so on. The bids are arranged in the ascending order from the small to large. Okay, and the bids can happen only below the repo rate. That means the bids can be done at below the repo rate, only below the repo rate. Okay, so for the variable reverse repo rate, remember that the reverse repo rate, this is the deposit rate of the Reserve Bank of India. This is the rate that RBI gives for the deposit that the RBI is taking, and reverse repo rate can only be lesser than the repo rate. So variable reverse repo rate, even if the bidding is happening, the banks are bidding for the interest rate, still in the bidding also the banks have to remember that the variable reverse repo rate, this can only be lesser than the repo rate. So this is the idea that further banks can place their bids at rates. So in the variable reverse repo rate, under this variable reverse repo rate, the banks can place their bids at rates lower than the repo rate while participating in the variable reverse repo rate. In the variable reverse repo rate, currently how much is the fixed reverse repo rate? The fixed reverse repo rate is, let's say, 3.35%. While the SDF rate is how much? The SDF rate is currently 5.25%. If I remember correctly, it is 5.25%. The repo rate is 5.50%. So under the variable reverse repo rate, the bidding can happen and the bids should be lower than the repo rate. So variable reverse repo rate can also be 5.49% or 5.41% or 5.35%. That will be higher than the SDF rate. So if the RBI wants immediate absorption of the money, if the RBI wants to absorb the liquidity immediately, so the RBI can use the variable reverse repo rate by paying higher, by allowing the bidding at the higher percentage lower than the repo rate. Got it? So if the repo rate is 5.50%, the banks can bid up to 5.49%. Again, up to 2 decimal points. All the other conditions are same. Just the under the reverse repo rate, under the variable reverse repo rate, the bidding should happen below the repo rate. Okay, this is the idea. Any confusion here? Many of you were asking about this. So now is it clear or not? No confusion? Okay, so this is the idea that the group recommends continuation of the variable rate auctions because the variable, if the RBI wants immediate absorption of the funds, the RBI can use variable reverse repo rate where the banks are bidding for the interest rate that they want to take from the RBI for the deposits that they are doing with the RBI, okay, and this rate can be lower than the repo rate. Okay, this rate has to be lower than the repo rate, but the rate is quite good and the banks want to deposit the funds at this rate, and the RBI can conduct the auction. RBI can conduct the auction for 25,000 crores, and whenever the RBI want, the RBI can conduct the auction. It can be for overnight or for 7 days or for 14 days as per decided by the Reserve Bank of India. Okay, so this is the idea. So the group recommends that. Now the group recommends, the internal working group also recommends that 14-day variable repo rate and variable reverse repo rate auctions may be discontinued as the main operation, because currently if the variable repo rate auctions are happening or the variable reverse repo rate auctions are happening, they are majorly for 14 days. They are majorly for 14 days. But the internal working group is saying that the 14 days timeline in the money market, the 14 days timeline is quite long. And if we have to manage the liquidity in the shorter term, the liquidity has to be managed immediately. So the variable reverse repo operation or variable repo operations, they should be like, the focus should be on 7-day auctions, so that in the shorter term we can manage the liquidity. In the shorter term we can handle the liquidity. If there is excess of liquidity, we can control the liquidity in the shorter term. If there is less liquidity, if there is deficit of liquidity, we can increase the liquidity in the economy. So group recommends that rather than following 14-day repo rate and reverse repo rate variable auctions as the main operation, we can manage the short-term liquidity. We can manage the shorter-term liquidity primarily through 7-day repo or reverse repo variable operations. The other operations will continue, the overnight operations or the 14-day operations, they will continue, and the RBI can decide that when these operations happen or when these auctions happen. So other operations of tenors from overnight to 14 days, at the discretion of RBI, the RBI can decide that okay, these auctions will also happen, at what time these auctions will happen. But the main operation should be the 7-day VRR and VRRR. I hope this is clear. Any confusion here? So basically the group is recommending that right now the main operation is 14-day variable repo rate or 14-day variable reverse repo rate. If RBI wants to inject the liquidity, RBI can lend more under the variable repo rate. If RBI wants to absorb the liquidity, if RBI wants to take away the excess liquidity, RBI can do the variable reverse repo rate operations, okay, to absorb the liquidity, okay. But these operations mainly happen for 14 days. So this can be discontinued as the main operation, and 7-day repo or reverse repo variable auctions can be the primary, can be the main operation now. The overnight and 14-day operations can continue at the discretion of the Reserve Bank of India, but the main operation will shift from 14-day to 7-day auctions. Okay, this is the idea. Now the next is for handling liquidity mismatches of longer term, because for longer term also the liquidity mismatches can happen when there is some foreign exchange problem that is coming and such. Okay, so repo or reverse repo operations of tenor overnight to 14 days are expected to handle changes in the system if they are happening for short term, okay, or for the shorter term. Let's say liquidity mismatches are only for overnight. So overnight auctions can handle that. 7-day auctions can handle any kind of short-term mismatches. 14-day auctions can happen the mismatches also. But what if the mismatch of the liquidity, that is there is too high liquidity or too low liquidity, there is mismatch or of the liquidity because of longer problems, okay. So these repo or reverse repo operations of tenor overnight to 14 days are expected to handle changes in system liquidity due to frictional factors, due to small term factors. However, in some scenarios, the liquidity mismatches may extend for a longer term. For handling such liquidity mismatches, operations of appropriately longer tenure may be conducted, like 28 days or 56 days or 3 months and such, okay. So till now they are not being conducted. So the internal working group is saying that for handling the liquidity mismatches for longer term, the group recommends that the repo or reverse repo operation of appropriately longer tenure may be conducted through variable rate auctions like 28 days, for 56 days, or for 3 months. Right now, majorly it happens for overnight, for 7 days, or for 14 days, with 14 days being the main operation. But internal working group is saying, first of all, change your main operation from 14 days to 7 days. 7 days should be the primary operation or the main operation, because it is able to handle the short-term liquidity better, the 7 days one, as well as for longer mismatches of liquidity, have the long tenure of the variable rate auctions also. Next is the group noted. So basically, the group noted that instruments under the existing LMF are sufficient for meeting the durable liquidity. That means under the liquidity adjustment facility, we have the SDF rate, we have the repo rate, we have the MSF rate, as well as we have the variable reverse repo rate, variable repo rate auctions. So these are the tools under the liquidity adjustment facility, as well as under the liquidity management facility. With the liquidity adjustment facility tools, we also have the open market operations, we have the foreign exchange swaps, okay, and such. So group noted that the instruments under the existing LMF are sufficient for meeting the durable liquidity needs of the system, and hence does not recommend any change at this stage. That means the existing LMF includes an array of instruments to address durable liquidity surplus or deficit. If there is too much liquidity, if there is very less liquidity, that can be handled by these tools, by so many of the tools that the LMF already has, the liquidity management framework already has. So the open market operation, along with other instruments such as long-term variable rate repo, reverse repo operation, and foreign exchange swap auctions, are used to inject or absorb system liquidity on a durable basis. This is the idea. Okay, so that means there is no new instrument that is required, no new tool that is required. Last one is, the last recommendation is that the group recommends the Reserve Bank to retain the existing daily minimum requirement of 90% of prescribed CRR. So if the RBI has prescribed the CRR at 4%, so 90% of the prescribed CRR has to be maintained on the daily basis, and on the fortnightly basis, on average, there should be 100% of CRR that has to be maintained. Okay, this we have already discussed. So this is it. Any confusion anyone has in any of the recommendation? So this is the first question. I hope you will be easily able to answer this question now. All clear? Nice. So this is the first question. I hope you will be easily able to answer this question now, as well as before going to the second question. This is the Perspective 360-degree series that is going on in YouTube at free of cost on Monday, Wednesday, and Friday at 5 p.m. And here the hot topics, the current topics, they are discussed in the descriptive form. The descriptive questions are given and the answers are discussed then. So you can understand that for your descriptive answer writing practice, this is a very, very good series. In this, the homework question is also given, and you can answer the question in the comment section below. The answers within 48 hours, they get reviewed. Okay, if you are answering within 48 hours, they get reviewed, and you also get feedback on your answers. This is a very good series for your answer writing practice, Monday, Wednesday, Friday at 5 p.m. Now, this is the first question. I hope you will be easily able to answer this question. Okay, the first question, here you have to tell that which of the following statements is or are true as per the recommendation under the report of internal working group. This is the second question. Again, a very easy question. You should be having the static knowledge of this, as well as in the recommendations also this is discussed. So this is it. Thank you everyone. Thank you for joining. I hope you enjoyed today's session, and see you in the next session. Do give me the right answer of the homework questions. So do give me the answer of the homework question. So thank you everyone. Thank you for joining, and